Welcome to JustFoods.com's webinar on how you, our international readers, see trading conditions in 2012. For those who have just joined the call, again, my name is Dean Best, Just Foods Managing Editor. Over the next 20 minutes or so, I will outline some of the key findings from our confidence survey, which we ran in February and March to find out how you thought the year would pan out for your business and for the food industry as a whole. With me, I have Rod Street, Vice President of SymphonyIRI's International Consulting Group. Rod will provide his own take on the results of the survey and outline what he believes are the challenges and opportunities facing the sector this year. There is no getting away from how challenging 2011 was for many in the food industry. Manufacturers and retailers spoke often about how tough the trading environment was last year. Dalton Phillips, Chief Executive of UK retailer Morrisons, said consumer confidence in this country was the worst in a generation. Ken Powell, CEO of US food giant General Mills, has said the inflation in commodity prices over the last 12 months or so has been the highest he has seen in 30 years. And something that Rod will touch on later is the fall in food volume sales seen in a number of major markets last year. There was, for example, a decline in the number of food items consumers in markets including the UK and Germany were putting in their shopping baskets, an indication of the pressure on consumer spending and therefore on food manufacturers last year. In short, 2011 was indeed a tough 12 months. However, when the results of Just Food's confidence survey came in, the team was surprised at the level of optimism among the survey's respondents. It showed many of you believe trading conditions will not get worse in 2012, and in fact, a significant proportion of you, over 4 in 10, believe the environment will improve this year. This optimism is perhaps also shown in the responses to our question on the level of growth you expect to see in 2012, the second pie chart. Almost 9 in 10 of you believe your business will grow in this year, and almost half expect it to grow by at least 5%. Of course, top-line revenue growth is not the same as volume growth, and once again, manufacturers will find it tough to increase volumes this year. Rod will touch on what suppliers perhaps need to do to achieve that kind of growth in 2012. So, while our survey indicated a level of optimism among you about 2012, it is consumer confidence and how optimistic they are about their own prospects that will determine whether the optimism among many of you in the industry materialises into tangible results by the end of 2012. And looking at a number of indicators, the prospects for economies in many Western markets remains uncertain. In the UK last week, the OECD forecast the UK's GDP would fall in the first quarter of 2012. The country's Office for National Statistics will publish its GDP figures later this month, but if the OECD is correct, the UK would have fallen back into recession after 2 consecutive quarters of falling national income. That said, the Office for Budget Responsibility, the independent body set up by the UK government to assess the country's economy, has forecast that UK GDP will in fact have grown in the first 3 months of 2012. Now, arguments among economists have been a feature of the downturn, and it's hard to say who will be right, but it is clear that in the UK, there remains a great degree of uncertainty over the state of the economy, which is hardly going to create the conditions for buoyant consumer spending. Moreover, data published by UK retailer Asda from the Centre for Economics and Business Research showed disposable incomes fell in February when compared to a year earlier. Not had the figures for March yet, incidentally. Figures published by the British Retail Consortium on Wednesday showed food inflation in stores accelerated in March, putting more pressure on consumers, which will have an obvious impact on manufacturers. There will be more on commodity inflation later. Moving across the Atlantic and trying to determine whether overall conditions in the US are improving is just as problematic. A look at the data coming out of the US last week only creates a feeling of uncertainty over that country's economic prospects. For instance, a survey from Thomson Reuters and the University of Michigan showed consumer sentiment rose to a 1-year high in March, and a second survey of small business CEOs in the US, carried out by Vistage International, showed confidence had risen to the highest level in a year in the first quarter of 2012. An increasing number of firms, it said, were planning to hire more workers. However, data from the Conference Board in the US was mixed. In March, US consumers were more upbeat about their present situation, but the board said its consumer confidence index fell because of less optimism about the short-term outlook. Fewer consumers in the US, for example, believe there will be more jobs available in the months ahead. the board said. The picture is mixed in Europe too. A European Commission survey issued over the last fortnight showed consumer confidence in the EU increased in March, although confidence among those in industry fell. Broadly speaking, however, I think that there is a degree of pessimism about the prospects for Europe in 2012. In Just Food's confidence survey, we asked you the region on which you were least confident trading conditions would improve this year, and almost 74% of you said Europe. Meanwhile, a survey carried out by US investment bank Sanford Bernstein, published this week, said what it called consumer apprehension and pessimism in the UK, France and Germany is widespread. Only 8% of consumers in the UK and 4% in France thought their economies were, quote, getting better, the bank said. And in short, therefore, there is a high degree of uncertainty about economic prospects in many Western markets. There's been the headlines on the debt levels in Spain, for instance, over the last 48 hours too. Consumers remain very cautious, and in these markets at least, the year ahead promises to be another challenging one for consumer goods companies. And to that mix, we must add the continued volatility in commodity costs. I think manufacturers were hoping the pressure of last year's commodity inflation would ease significantly in 2012 and help bolster margins at a time when consumers remain uncertain about their spending power and economic prospects. At General Mills, again, for example, Ken Powers said the company strongly believes commodity cost inflation will moderate. However, food manufacturers have seen pressure continue in 2012. Some commodities remain stubbornly high, like sugar, soybeans, nuts. Others have reached annual highs in recent weeks, palm oil, and the cost of other ingredients have escalated in the wake of regulation, thinking about eggs in the EU and the new animal welfare laws that have been brought in. In our survey, over 41% of you said you expected your commodity prices to be higher this year than last. A further 30% expected raw material prices to be volatile this year. In the round, commodity inflation is probably unlikely to hit the level seen in 2011, but the signs do point to ongoing significant pressure in parts of the manufacturer's commodity bill. In our survey, over 75% of manufacturers said they would be trying to push through price increases to retailers in 2012, as shown by the second pie chart on the slide there. However, earlier I mentioned the data from the British Retail Consortium. That was released yesterday on what it calls shop price inflation. In March, there was the largest month-on-month increase in the rate of food inflation in UK stores since August 2010. Inflation accelerated in categories including meat, fish, convenience food, and there was also what it called a sharp rise in bread and cereal prices. The data does suggest, therefore, that some manufacturers operating in the UK have been able to pass on some of the commodity inflation to their retail customers. However, for all the pressure on their commodity bill, manufacturers need to be wary about how far they try to push through price increases. Retailers, facing cautious consumers, may not always be ready to pass on the full extent of price increases. Now, major multinational FMCG manufacturers do hold some pricing power over their retail customers and can pass on commodity cost inflation. That said, continued inflation, not just from the shopping basket but also at the petrol pumps, will put more pressure on consumers, and elasticity of demand can only go so far. Price hikes last year hit volume sales in a number of markets, and the major manufacturers, even if they could succeed in getting price increases through, may have to decide to hold back to maintain consumer demand. Where retailers do hold more power, perhaps, is with their private label suppliers, which can face a longer lag in seeing commodity inflation pass through. In short, the picture on commodities in 2012 may not be as straightforward as some might have felt it could be as 2011 drew to a close. Pressure remains in certain areas, and we cannot discount the price of oil on all parts of food distribution. Add to that concerns over crop yields in Northern Europe amid the recent dry weather, and some industry watchers believe that pressure could continue into the second half of this year and maybe even beyond. Manufacturers will therefore face all sorts of challenging decisions in terms of consumer demand and retail negotiations for months at least. And that leads us on to M&A. This year, retail giants like Carrefour and Metro have new CEOs in place who both be desperate to revitalise their businesses after a challenging 2011 when both saw profits fall. Here in the UK, Philip Clark has just marked his first year as Tesco Chief Executive and will be uncompromising in his quest to turn around the retailer's fortunes. What could this mean for suppliers? Well, when combined with continued pressure on costs, it is likely to mean the industry witnesses more consolidation, I think, in 2012. Facing retailers battling for market share and looking to their suppliers to fund promotional activity, manufacturers may find it necessary to join forces or acquire rivals to gain scale and a degree of bargaining power. In our confidence survey, we asked you whether you thought there would be more M&A opportunities for your business in 2012. Over 44% of you believe there would be more opportunities this year. Of course, an opportunity does not always lead to a deal. 2011 was a year in which an expected flurry of transactions didn't materialise. There was the prolonged economic stagnation in the US and Europe, the latter's problems exacerbated by the sovereign debt crisis. And that kind of led to a mood of conservatism among manufacturers that could have been looking to expand via acquisition. And while the argument that intensifying competition between major food retailers could mean more deals among food manufacturers this year is a strong one, and some argue there are signs that deal volumes are in fact picking up, concerns over the economy that are lingering on or tight financing conditions could limit any wave of consolidation. There is, however, an air of cautious optimism among M&A advisors. Spain Lindsay believes deal volumes are on the rise, and Grant Thornton has told us that both private equity and trade buyers view M&A in the food sector as, quote, a strong opportunity this year. Private equity will remain a competitor for manufacturers looking to acquire, although there is some debate over which kind of business will be at the forefront of any deal making. The level of debt finance perhaps available to private equity has declined from the heady days of the mid-noughties, although it is argued that buyout houses have the experience of doing deals that some smaller food manufacturers may lack. The M&A advisors at Spain Lindsay have argued that, quote, a lot of roads lead to private equity when considering who could be the main buyers of food and drink businesses this year. It argues that there is a lot of capital in the private equity world, and it says food companies with their stable cash flows remain top targets for private equity firms. Further down the slide, and there is also some debate over whether more companies from the powerful emerging markets of China and India will become buyers of consumer good businesses in the West. There have been one or two deals made. China's Bright Food acquired Australia's Manison Foods last year. In 2010, an Indian company called Jain Irrigation snapped up an ingredients maker here in the UK called Sleaford Quality Foods. However, perhaps the major one that was in the offing, Bright Foods' bid to buy United Biscuits in 2010 failed to lead to a transaction, and there has not as yet been a wave of deals. Nonetheless, Grant Thornton has told us that businesses in developing economies may become more interested in Western firms. They argue perhaps that companies in markets like the UK have built up a lot of expertise in distribution, technology and branding, and groups in China and India may want to attain that knowledge for their own businesses back home, and could do that through acquisition. Takes us on to the emerging markets now. This was a key focus of our survey. We asked you which of the BRIC markets filled our readers with most confidence in 2012, and half said China. Now, of course, investing in these markets, either via a distribution deal, capital expenditure or acquisition, is risky. For the potential of selling into the huge consumer markets of China and India, there are pitfalls too. On one hand, for instance, this week, the IGD said China would become the world's largest food retail market, underlining the opportunities available to manufacturers there. However, India is mulling a retrospective tax on any overseas deals involving an Indian asset, a proposal that has attracted criticism from business organisations around the world. In reality, entering all of these markets is risky and involves dealing with underdeveloped distribution networks and uncertain regulatory climate, and perhaps crucially, consumers with very, very different demands and tastes. That said, our emerging markets pages on Just Food have seen a steady stream of news at the turn of the year. Nestlé, Barry Callebaut, the major multinationals, continuing to invest in developing markets. Notably, the very US-focused J.M. Smucker is making its first investment in China. And perhaps on a smaller scale, UK crisp maker Tyrrell's is starting to sell products in that market too. So there is opportunity for small and medium-sized enterprises, I think. And don't forget, a key reason for one of the big mega deals of 2012 so far, Kellogg's move to buy Pringles, was so the cereal manufacturer could exploit the brand's presence in emerging markets. When faced with the mature markets of the West, with their slow economic growth, aging populations, consumer good companies need to act faster and try to gain a foothold in the emerging markets today, which will for certain be the powerhouse economies of tomorrow. In some cases, already are. The answers to our emerging markets question allow readers to specify which other countries they view with optimism this year, and markets from Colombia to Turkey to Vietnam are offered up. Combine that with the 50% of readers who said their businesses would be spending more money this year trying to increase their presence outside their domestic market, and it is clear that, even in tough trading conditions, building an international business remains a priority for many in the industry. Finally, from me, some thoughts on sustainability. There could be a whole survey conducted on this issue alone. Sustainability can look at issues from water use, carbon, fair trade, child labour. But in our confidence survey, we focus on one area: companies' investment in reducing their impact on the environment. And it appears that, even in such challenging trading conditions, the food industry is keen to target spending on alleviating their impact on the environment. Most interestingly, a third said they would increase their investment in this area this year, which is roughly the same proportion of those in our survey who said they would increase their investment in R&D. That was around about 38%. Just shows the importance that issues around sustainability are gaining now for food companies. Despite operating in some of the most challenging trading conditions for a generation, industry still appears to be ready to look at how they can reduce, for example, their carbon footprint or their water usage. Could be a sign of the underlying optimism outlined elsewhere in the survey, that trading conditions will improve and allow investment in such initiatives, but it's just as likely that manufacturers and retailers see the business benefit of investing in this way. Cutting energy use and making distribution more efficient can be lauded as sustainability initiatives, but are also effective ways, frankly, of reducing costs and bolstering profits at a time when sales are under pressure. Of course, over time, as companies move more deeply into their supply chains and seek greater impact reduction across the board, the challenges become tougher and the need for significant long-term investment will increase. In other words, perhaps the true commitment of companies to the sustainability agenda and not merely to business efficiency will be increasingly tested in the years ahead, I think. Okay, thanks for listening. I'll now pass you over to Rod, who will outline his thoughts on our survey's findings and on the industry and consumer landscape for 2012.
Thanks very much, Dean. What I'd like to do now is just to give you some, in a sense, personal reflections on the confidence survey, and perhaps add a little bit of commentary and the areas particularly which I felt raised challenges for businesses in the sector. What I wanted to do, though, was to first start with a quick overview on what to me were the key takeouts from the survey, which were a little bit surprising. I think, as Dean commented earlier, the optimism in the survey to me came as a little bit of a surprise. Whilst most people expect 2012 to be very much like 2011, the way people view the year is they view much more upside opportunity than downside risk, roughly 2 to 1. The confidence that this year is likely to be better than last year, which is great, but comes as a little bit of surprise to me in that when you look at some of the underlying factors, and I'll talk about this in a little bit, they don't seem to me to have moved that much forward from last year. I think what it probably reflects, though, is the fact that the uncertainty that everybody has felt, particularly in the back half of 2011, on the economy and some of the very big economic backdrop issues seem to be falling away. Now, behind those issues, the thing that is quite interesting in the survey is that the immediate economic pressure points don't seem to have changed some of the underlying trends in the industry. You're seeing the same drive to internationalisation that's been there for quite a long time, and roughly 60% of the respondents are going to spend more this year than last year in trying to internationalise the business. Dean's just commented on the sustainability area, which is another one which continues to gain ground. The health properties of product, nutrition, health and wellness agenda, that's also carried on. And those factors are running on despite the worst recession since the war. And that reflects the fact that companies are driving clearly to find areas and pockets of growth which pick on not just geographic areas which are in growth like emerging and developing markets, but also opportunities within the more mature markets. The one thing that does come out in the survey, and again Dean commented on this, is that most respondents see the Eurozone still being quite mired this year, and even separate out Europe and the European economies in the Euro from the UK and the US. I think, therefore, if I was to try and sum it up, it seems to me that what we've absorbed is 3 or 4 years of very, very difficult economic conditions, and coming away in the survey with a mild optimism about the future, despite the fact that people foresee continued austerity, at least in the advanced economies. Now, what I want to do is comment on 5 aspects of the survey that I think raise interesting questions and challenges: growth, prices, channels, innovation, and then the individual position of each company. So just taking those in turn. The first one is the growth agenda. This was something that came across very positively by people. Roughly 80% are expecting things to be either the same or growing, and over half of respondents are expecting more than 5% growth in 2012, which in the context of the Western economies, which have really not seen much by way of growth over the last couple of years, that's really quite an optimistic response. As Dean commented, in some of the big food markets, UK, Germany, the Netherlands, you've seen food volumes actually tip downwards in a sustained way. Probably for the first time you've seen them come under pressure. And in many others, you're seeing volumes as being pretty flat. Therefore, growth, unless it's going to be international, unless it's going to be in emerging and developing markets, is going to be growing at the expense of other companies in the market. And I think that does reflect what I was seeing in some of the responses. There really is a strong international drive and an international flavour in the response. And what people are seeing is the opportunities, particularly in emerging and developing markets. And also, secondly, opportunism around the mergers and acquisitions area, which I think people see as an opportunity to gather position and strengthen position ahead of any upturn sometime in the future. But what it brought home to me as reflecting on it is the challenge that presents to companies, in that to actually grow in a static market, you've got to provide a reason for growth, and that's got to bring up, and I will talk about this in a minute, the whole area of innovation, product innovation, process innovation, even innovation in the business model, and the way that additional value can be squeezed out. And it also is going to demand an entrepreneurial mindset. And I think the question, certainly I see in a number of the clients that I deal with, is the challenge that focus on innovation and that focus on opportunity that's in the entrepreneurial mindset has in the face of, really quite adverse financial conditions and stringency. So growth, very much on people's agenda, something of a surprise from my point of view in terms of the strength of the response. And I guess my challenge on that is looking what's behind that. What's the rationale behind that growth? Is it all international, or actually is there also a great deal of effort going in looking for opportunities in those home markets? Second area that presented, quite a pause for reflection from my point of view, was the whole area of prices. These are seen to be very much on the rise. There was, we've talked a little bit about commodity prices, which have jumped markedly over the last 4 or 5 years, and jumped in 2011. But in fact, what we haven't seen is that necessarily seem to feed its way all the way down the value chain to the shopper and the consumer in many markets. Yet the survey suggests that 75% of manufacturers will pass through cost increases and price increases through to their customers this year. And that would have to be something that's very different, I think, to previous years. Now, that could be need in terms of maintenance of margins, maintenance of the funding for investment, and a reflection of the fact that people are expecting commodity price pressures to remain. But it's going to have to be done in the face of a still very difficult market. The Purchasing Managers Index is probably an index some of you will be familiar with. Every month or so, all over the world, purchasing managers are surveyed for their purchasing intents, and an index is produced out of that, which, if it's over 50, it basically indicates better economic conditions, and if it's below 50, it indicates adverse conditions. One was published just at the beginning of this month, which had globally a pretty flat index, around 51. In the Eurozone, down at 49, and in places like the UK, slightly more optimistic at 55, seeing evidence of at least a short-term blip. But that's still very flat. Confidence in markets remains, despite the fact that it's picked up, incredibly low by historic standards. And world trade, whilst it has picked up over the last 5 years by around 8% in volume terms, is down 4% in the advanced economies. And where it's really picked up is in the emerging economies, where it is up somewhere in the region of 20%. So pushing prices through means that companies are going to have to face a consumer that's going to resist price increases, and a concentrated retail environment in these advanced economies, which have in the last few years pushed promotions up and kept prices down. What that's going to demand, I think, is a real core focus on how to execute on those companies that are planning to pass the prices through. What's the best way to get that price increase through successfully without losing volume? Is it going to be focusing on unit price, or is it going to be focusing on overall volume? Where is it going to be taken within the product mix? Is it going to be a focus on the everyday price, or is it going to be focused on trying to dig out the promotional area and perhaps offer less deep discounts? Is it going to be done by channel? That kind of granularity, I think, is going to be critical if the expectation of passing prices through this year is to be realised by companies. Third area I wanted to touch on were channels. The survey points to a return to what I've described here as traditional channels. Part of the survey looked at where companies were going to place their priority. Was it going to be on, the burgeoning online channels in advanced markets? Was it going to be on the convenience channel, another area of growth in many different economies? Was it going to be on mobile, or was it going to be back on the traditional channel? Most people are focused on traditional channels, so the core grocery channels, and that seemed to be the area of most prospect for growth over the next 12 months. And that, I think, is very realistic. Whilst the figures for growth, for instance, in the e-commerce area are very high, I've put the figures on the slide as a rough guide for Europe. At 20%, you're dealing with a very, very small base. And the sort of backbone of the grocery industry in terms of hypermarkets and supermarkets, the large stores, still remain probably the largest growth opportunity in absolute terms, even though e-commerce is growing so quickly. Now, that may well change over the next few years as mobile becomes a key force in the shopping trip experience for people, and also as more multi-channel approaches, click and collect services start to build and penetrate a wider group of shoppers. But it is certainly the case that distribution is key for most products. Perhaps prime examples like Coke, with their aim of putting a Coke within arm's length of every consumer, are really good examples of how important it is to secure very broad distribution for products across many different channels. And I think the opportunities that presents in terms of looking for incremental channels for product, even in the home market, for many businesses, is very important. Again, it's going to be an important driver for growth within the industry, and the return to traditional channels, whilst I think it becomes very important, it needs to be supplemented by some of these other growth areas if businesses are to be well positioned for things in a couple of years' time. Fourth talking point is innovation. This came out in the survey as a strong point of emphasis in terms of investment by companies both last year and this year. Interestingly, though, even though 60% of businesses were looking at investing more this year than last year, many businesses are expecting slightly less out of that in terms of products. Now, that might be because innovation is being focused on other aspects of the business, on processes, on new models, but it could equally reflect the challenges that I think exist for many food manufacturers in delivering meaningful innovation for consumers. One of the things that we've observed in the industry, we did a particular study in the UK last year that brought this into sharp relief, is the challenge that faces food in particular. So in FMCG, roughly 60% of new products are in the food and drink area, core food and drink rather than necessarily things like confectionery. But actually, the average sales in a year of new products is lower in food than it is across FMCG as a whole. Partly it reflects the sort of success rates of new products, which in terms of delivering products that fly out of the store at the same level as products that are already there, is roughly only 1 in 5. And partly I think it reflects the difficulty that food businesses having finding sustainable points of differentiation. And I think, again, this is where an entrepreneurial mindset really is going to be extremely important in digging harder in food to provide a real reason for difference. And that's, what I see in clients is it's about revisiting old products and looking at how they can be repositioned, looking at new usage occasions for products, cross-category combinations, new impulse opportunities with shoppers. It's about working much harder at what's already there in order to get that growth. And I think it's also about being pretty intolerant about seeing any drop-off in the productivity of investment in innovation. Fifth and final talking point from my point of view was just a reflection on individual companies. I've heard other analysts talk about this being very much an individual recession when you come to the food industry, in that it really only hits a household if a household finds that the head of household becomes unemployed and their income drops off enormously. But actually you can see some behaviours in the industry that permeate. It's actually not just the advanced markets. You can see it in some of the emerging markets as well, of the fact that consumers feel under pressure. They feel there's a bit of a recession. They are paying much more attention to prices. They're being far smarter about how they shop. As I mentioned earlier, consumer confidence remains low in many different advanced markets, and many households are feeling that costs of other things, let alone food, are putting pressure on salary. And as a result, they are being very careful about what they spend money on, and it's far harder for companies to rely on price inflation or small incremental innovation to drive growth. Yet our survey, comes back with a very optimistic picture. To achieve over 5% of growth in a market that you're in would be quite successful. If it's driving to new international markets, maybe less so. And that's in the face of a couple of challenges, I think, which I've flagged on the slide. Firstly, you've seen in a number of the big FMCG companies budgets being cut because of the financial pressure, because of the difficulty of delivering earnings growth in the face of much slower revenue and margin growth. Can these big companies actually deliver growth by cutting budgets? I think quite interesting. If people have got comments or questions on that, I'd be very interested to see what people's response is on whether or not you feel that is a route to growth, or whether actually it's just a route to becoming slimmer and postponing some of the pressure that's there. And secondly, I do talk with people, and a lot of people are continually looking for the economy to bounce back. When's it going to bounce back? When are things going to return to some element of normality in the Americas or in Europe? And I do feel that we need to get to a position where we understand that the economic fundamentals, given the financial drag that the advanced economies are under, means that we're probably not going to see a bounce back for many years, 4 or 5 years. Even though there's been a bounce back in the States in the back end of 2011 and early 2012, you've got a presidential election coming, and you've got the most enormous debt overhang that at some point the States is going to have to start to address. And so I think a second question I've got is whether the optimism on growth in the companies that responded in the survey is to do with a unique position, to do with better economics, to do with international opportunity that you can see, or perhaps it's to do with M&A. And again, I would be very interested as we move to the Q&A session in understanding a little bit more about that. What I wanted to leave you with was just one final thought. Because to me, the fundamentals of where we are in 2012 are not going to be much different from where they were in 2011. Yes, I think there is some more potential upside in 2012, but there are still very significant downsides. And if we'd been doing the webinar at the beginning of the week, that might make less sense. But all the markets dipped, if you were been following the markets in the last 2 days, as investor sentiment again has caught a cold downdraft at worries over sovereign debt, economic prospects in a number of the advanced economies, and indeed some questions over some of the emerging markets, notably places like India, the building boom that's been going on in China, and other places like Brazil. So right at the core of the BRIC economies. So to make for growth, to make for prospects, it seems to me that businesses need to have a very good answer for what they're going to be doing different this year from last year that's going to make business better, that's going to deliver that growth, and that will fulfill the optimism that I think really did come out of the survey. So thank you for that very much. I think we're going to open it up for questions. I'm going to hand back to Dean as we start on to that session.
Hi, don't forget you can post your questions in the Q&A box, or if you're having technical problems, you can send them via the chat box too. Rod, I had a couple of questions arising from your presentation. One of the points that struck me was your supposition about a return to traditional channels. It's quite interesting given the forecast around the online channel, and also there's been some quite poor comments about hypermarkets. I think the CEO Morrison's called them soulless sheds. Tesco's CEO has said that they're probably going to invest a bit less in larger stores. I just wondered what you kind of made of the hypermarket business, really.
I mean, I think it's very interesting that I had expected that some of those retailers, particularly in the UK, retailers like Tesco that had big hypermarkets with good non-food offers, might have done quite well in being able to reuse the space in the hypermarkets through the recessionary period. So as spend came squeezed, they'd be able to resort their portfolio and use that. And I was somewhat surprised at the evidence of people like Morrison's and Tesco's that that's not where opportunity is being seen. The consumer is actually trading out of that area, and people are starting to focus back in the core food area and actually into smaller shops. Now, I think we're probably at the very early, very early signs of seeing some moves in the multi-channel area. And I think it was commented on by Tesco, I can't actually remember, that they saw people buying a lot of the consumer durables increasingly off the internet. And therefore the fact you were devoting your hypermarket space into those areas was actually one of the reasons that hypermarkets as a whole were not performing. So it wasn't specifically food, it was more specifically what they were using the rest of the space for. I think that's a real challenge. I just think of it at a personal level. When you go round some of the stores to showroom shop, you then do go online and you check and see what comparable deal you can get online. And that clearly is hitting a lot of the electricals retailers. It's clearly hitting the hypermarket space. And then you say, well, how much space do you really need in a food store? If it's a core food and drink store, do you really need the scale of space? And I think it's probably right, you don't. And as e-commerce comes in and starts to permeate with click and collect services, even more of this space is going to look redundant. And I do think that in many advanced economies, and the analysts are commenting on this on the big store chains, the growth in space that we've seen and the plans for growth in space over the next few years start to look potentially problematic for returns for all the retailers.
Okay. Well, one question we've got coming through is the kind of business that can succeed in passing on commodity cost increases. Analysts have spoken to me, for instance, about the power that major multinationals have, and the likes of Nestle, Unilever perhaps do have some pricing power. I guess the obvious answer is if you've got strong brands, you're more likely to be able to pass on your price increase. Is it as simple as that, Rod? Is there a kind of more nuanced argument, or is it really about the strength of your brand, would you say?
I think it is heavily dependent on the strength of your brand. So there have been one or two high-profile cases of people being delisted when they've tried to get price increases through, which have probably been commodity price generated. But I think it's also about the engagement and the presentation of that argument with the retailer. So retailers are not naive about commodity price increases. They have their own label products, which are increasingly important, and actually they're not daft in terms of needing to maintain the price premium of the national brands over their own label. So actually you can have a constructive discussion, I think, in that area, but critically you have to then still convince the shopper. And so even if you move and the store chain moves, they still could move store chain, and that will depend on the power of the proposition, both at the retailer and at the manufacturer's brand level, I think.
Okay. Another question we've got is how companies can squeeze out growth in these trading conditions. NPD is risky, there's the commodity pressure. Certainly, personally, some of the sort of NPD we're seeing in the UK often sort of focuses around new variants, new flavours, limited edition products where companies seem to be hedging their bets a bit. So are there particular, I think you mentioned new usage occasions which kind of hurt my attention as being very important. So what are your thoughts around the key areas that they should focus on?
Well, I think there's, new usage occasions, I think this is one of the reasons I mentioned, although people are putting a great emphasis on the traditional channels, I think some of the other distribution channels, pharmacy, drugstore, kiosk, small convenience outlets, I think those are quite important, mainly because a lot of food is still quite impulsive in terms of purchase. And your ability to tap into that in terms of tapping into offers in some of these small, I think particularly small retail channels is quite important. Usage occasions and reapplying your product in new areas is clearly an opportunity. But I do think growth is difficult. I mean, one of the reasons I raised the question over can you cut and still grow. And I think what most of the majors are thinking is that we cut back on our marketing spend, we cut back on the complexity of the way we operate, and we focus that money on the core brands with the hope that that cuts through in the message to the consumer. And I think there's an element of truth in that. But I think it's still quite a challenge in markets where you're seeing no volume growth.
Okay, thanks, Rod. One question that's just come in is whether you're seeing any shifts in volume by distribution channel, i.e. ambient, stable long life versus frozen versus chilled.
Not big shifts, no, between those. There is a sort of an obvious fillip to frozen in the UK if you just look at the Iceland chain. So the Iceland retail chain, which just sells frozen product, actually was in a very difficult position. You see it's actually done not badly in the last 12 to 18 months as it's seen to have prospered from its positioning. But I think as much as anything it's a price positioning than it is a shift in format. There's not I've not seen anything certainly in the main European markets. I'm probably not quite close enough to the States to have seen shifts in volume and by format there.
Thanks, Rod. Questions come in on internationalisation and what our perceptions are from the survey data of where short-term growth will come from for producers here in the UK and a view on investment levels needed to drive that. Personally, I mean, my view is clearly a company needs to be a certain size to be able to invest in overseas markets, also to sort of try to carry that risk, because going into any new market does carry that kind of risk. I mean, that said, though, I kind of raised the example of Tyrrell's. Now, you know, Tyrrell's is a kind of upmarket brand here in the UK, but it's still, relatively speaking, compared to the kind of multinational competitors that it has here in the UK, a relatively small business, and that's been able to open up new markets, not least in France where it is quite strong, but also further afield.
Yeah, I mean, I think there was a question towards the back end of the survey which people were able to answer in a long form way, which was quite interesting, and it doesn't really answer the question that's come in. What it told me more was it was to do with people seeing growth in those core international emerging markets. There was a lot of comment over places like China and strategies for entering China in particular. So I think in terms of, I don't know whether it counts as short-term growth, but I think it was people looking to grow by moving product in new international markets, much more than growing specifically where they were.
Mm-hmm. I think another point I'd like to make to that specific question is that there is some support in the UK, at least, from the Industry Association, Food and Drink Federation. The government's providing or looking to provide the industry with some support to open up new markets overseas. How successful that is, I guess, remains to be seen, really. Another question we've got: what categories are driving growth within food? I think you kind of touched on one just now, didn't you?
Yeah, I did. I mean, what I will do on that, I haven't got immediate figures to hand, but we have got figures. So I will, when you do the follow-up, what I will do is I will give you some figures at the category level to answer that, just so that you get some idea. It'll be biased particularly into the West European markets, but it will give you an idea. It is remarkably local. That's the one thing about food. So it's a bit difficult to provide general stuff, but I'll try and give you a couple of follow-ups in that area to answer that question.
I mean, looking at perhaps the so-called ethical categories, what I have found interesting over the last 12 to 18 months is that organic sales, perhaps not in France or Germany, but certainly here in the UK, have continued to fall, whereas the kind of analogous categories, fair trade, have actually managed to increase sales. I think that's perhaps a whole different argument, but that kind of centres around the clearness in message that fair trade can bring to consumers compared to the kind of different proxies that people use organic for in terms of health and natural, local, that kind of thing. There was a comment that came in a bit further up that I'd just like to put out there. The comment said it sort of sounds like Tesco Direct has replaced Tesco Extra, and therefore the assumption here is that is also that reliability on consumer goods has become a given, as has consumer knowledge about knowing exactly what they want. Is that something you'd concur with?
Well, I think it's a good comment, actually. I'm not quite sure whether the comment is suggesting that is the case or is kind of questioning it. It is certainly true that the online services are not as predictable as you know. If you go out and buy a television, you can observe the spec and it arrives and it's a manufactured product, so it's absolutely quality controlled, and if it's not right, you just send it back. That's not true on fresh. I mean, fresh product kind of is what it is as it arrives. So it's for the staple for a lot of food stores, which in profit terms is the fresh area. It's obviously a lot about how good their own supply chain and quality control procedures are in terms of providing something that consumers go, yeah, that's what I would get in store. I think most people don't perceive an enormous quality problem in most of the Western markets, certainly around packaged goods, certainly around the fresh area, and so they probably do treat it very much like it's a known quality. But you wouldn't need much to get people to question that, to be honest. So I think it's an interesting point.
I know that when we've spoken in the past, and you've highlighted in your column on Just Food about the sort of the drop in volume sales in markets like the UK, Germany, and Holland. I mean, do you think, in broad terms, volumes can increase this year? Was last year a one-off, or will it be challenging again?
I think it's going to be challenging again. I don't think we're going to see them fall. I actually think it's very difficult to see volumes fall, even by, I mean, they only dipped down by 1% or something, so it's small, but that's actually still quite difficult to envisage, because it means people are basically taking in less, because it's a volume measure, it's not a value measure. So I don't think they're going to drop more, but equally, I don't see much in terms of growth. I mean, consumer confidence, whilst it has tipped up in a lot of the markets, is still at incredibly low levels. I mean, it's well below where it was in all the West European and US markets, say 4 or 5 years ago. And whilst the US economy has just about climbed out to where it was in 2007 or 2008, that's not true in Western Europe. We're a long way away from it. I think people are adjusting to it, and so I think people get used to what's there. But I don't think people are feeling flush in any of these markets.
Coming to a close now, should we try and end on a bit more of a positive note, given that it's Easter? Where do you see the opportunities, broadly speaking, for companies this year? You kind of mentioned that companies need an entrepreneurial mindset to succeed, and are there areas where people should be optimistic about opportunities this year?
Well, I think there are opportunities internationally. I think that comes out of the survey, and I think that's absolutely right. So in the broad canvas, both for big companies and for smaller companies, making sure that your international position is sound, and that the priority being given to the emerging economies is high, is critical. If you start to look domestically within the advanced markets, I would look to channels. So I would look at the breadth of coverage you've got within channels, what position you've got within the growth channels, both convenience and online. I'd take a fairly defensive posture within traditional channels. I just think it's going to be very tough. And then behind that, there are really the fundamentals, which is being able to come up with some meaningful forms of innovation, meaningful from the shopper's point of view, and making sure that you're getting the communication of that to the shopper. So there is definitely leverage with the shopper in terms of the branding. of your products and making sure it's high on the list. Shoppers don't buy that different items in a year. You know, they typically buy 200 to 300 SKUs. They are pretty much the same. Therefore, to get some movement, get yourself into their basket, that's quite a hard job. And having a brand makes it a whole lot easier to do that.
Thanks very much, Rod. I think time's pretty much up now. So an audio-visual version of the presentation will be available within 48 hours. There'll be a full report on the confidence survey in our management briefing section on justfood.com later this month, which will also feature Rod's latest Street Talk column. So I think that just leaves us to wish you all a happy Easter. Hope you have a good break, those who are having a few days off, and try not to eat too many Easter eggs. Thanks very much.